and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school settle-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal. It's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO at Deal Room and chief scientist at M&A Science. Joining me today is Haley Van Cleve, partner at Alpine Investors. Alpine Investors is a $17.8 billion AUM private equity firm investing in software and services businesses. Alpine specializes in acquiring businesses and scaling them through a flexible approach that blends operational support, deep integration expertise, and a standout talent model. Alpine has hired over 150 high attribute leaders into its portfolio company through its popular CEO and training program, which is the number one most applied to jobs among graduating MBA students at Stanford Graduate School of Business, Harvard Business School, and Wharton. Today, Alpine has closed over 850 deals, including 170 deals in 2024. Today, we're going to talk about what it takes to build a successful buy and build platform from the ground up. Haley, how you doing today?
Good. Hey, Kisan, so excited to be here, and thanks for coming out.
Thank you for hosting me live here in Manhattan at your office. Is this headquarters or is it?
We are SF headquartered, but we have a New York office, and we're almost 50-50 at this point.
Wonderful. Thanks for hosting me in your New York office.
For sure.
Great location. It's convenient. Can we kick things off a little bit about your background?
For sure. So as you said, I'm Haley. I've been at Alpine for about a decade now. I joined straight out of undergrad. I studied computer science engineering. I thought I wanted to do many things. Didn't know what private equity was, but got connected to Alpine through a classmate of mine who put me in touch, and ultimately got to talk to some of the partners at Alpine, and just felt like it was a place where I could learn a lot from smart people who seemed like good humans as well. I really knew nothing about finance or private equity. In my interview, I always joke I used revenue and profit as synonyms in my case study. So I was very green, didn't know anything, and joined as an analyst and have been here ever since. At the time that I joined, the firm was about 20-ish people. We're investing out of our fifth fund, which was a $400 million fund. And if you fast forward to today, we're about 180 people across 3 offices, and investing out of a $4.5 billion fund. So it's been an incredible journey, a ton of growth for Alpine, and just an incredible ride.
How many years and how many deals have you worked on?
About a decade. Deal-wise, I've lost count, but probably 45 plus.
Awesome. I'm curious. I'm always intrigued by people with an engineering background, just because I can tell they interview different. Even though you didn't go out and practice in an engineering role, but do you think anything that from that just background in undergrad helped you with being an investor?
I think definitely. We have a ton of people from technical backgrounds and engineering backgrounds. I think deals are a lot like a problem. You have a hypothesis, you're going to get data, you're going to test assumptions, you're going to try to figure out logically what makes sense next. And so I think just that framework of logical thinking totally applies to deals and applies to businesses as well.
So there's other people like you in this organization?
Yeah, so we hire primarily out of undergrad for our Alpine team, and they're folks from, all different backgrounds. Some were finance majors, business majors, but some were engineers or political science majors. And so we're big believers that, it's about attributes, and it's about people who are intellectually curious and excited to learn about deals, and you can teach, people of any background how to become deal makers.
I like it. I'm just curious how that lends into the culture here at the firm. Let's talk about platform deals. What defines a platform? How do you identify a business that would have the strong potential to be a platform?
I mean, traditionally when people talk about platforms, they usually mean something with scale and something with certain capabilities. So maybe a business that has M&A capabilities. We take a pretty liberal view of what a platform can be. We focus on what are the things that are really hard to build that we are not good at and take decades to build, and what are the things that we can add to a business. So for us, a platform needs to have high revenue predictability. It needs to be in a good market. It needs to kind of have good bones as a business. Raving fan customers, really repeat and high retention revenue streams. Those are things that are very hard to build and take decades to build. On the flip side, for us, we do platform deals that are smaller. So we'll do a platform deal that's, $3 million of EBITDA, or in software, $3 million of revenue. And we can help kind of supplement and build a platform team. We can add M&A capabilities to a business that maybe hasn't done M&A. So for us, a platform is really a business with good bones that we think we can add things around and ultimately build into a more traditional platform.
You got strong customer base. You got good operating mechanics. Like, this looks like a good, well-run business. I'm curious about the size part, because I was under the impression that you needed like 20 million in revenue to be looked upon. And is it fair to say like maybe firms have a different definition of a platform too?
Yeah, scale is definitely all relative. So relative to the firm, relative to their strategy, relative to their capital base. I think for us, oftentimes we're building a lot of platform capabilities over time. And so we will start smaller, and we're investing out of a $4.5 billion fund. We will start platforms with a $2 million EBITDA deal or a $3 million EBITDA deal, where we know that we can build that into scale pretty quickly through M&A. On the software side, that might be, 3 or 4 million of revenue. So I think a lot of other firms have want to start with a little bit more scale, but for us, that's really one of our core competencies, is adding M&A and ultimately kind of growing a business pretty quickly into a scaled position.
Hey, let's break down software versus service. One, I think it's pretty cool that you have like two clear focuses, but they're so different. Because you sort of referenced right away, you're like EBITDA versus revenue. And I'm a software person, so I'm going to be very biased and even sometimes use my own company as an example, since we're sort of at that growth stage thinking about acquisitions. But I think it's so true. In a service business, you are thinking bottom line profits, and a software business, maybe not as much. Is it the expectation software businesses tend to operate in losses, break even, or just not as much profit focus?
I mean, in software, there's a ton of variance. So there definitely are businesses that have operating losses or running break even. There's also, really since the public cloud came out, the ability for founders to bootstrap businesses and run them at decent profit margins, even, at 3, 4, 5 million of revenue. So we kind of see a variety. We tend to focus on Rule of 40 businesses in the software side. So businesses that have some margin, maybe it's lower margin today and they're going to scale into a more normalized margin over time. But definitely in the software side, when you're 3, 4, 5 million of revenue, we're thinking about how much can we scale that revenue over time. And then from a bottom line perspective, once they hit 10 million of revenue, what do we think the normalized margin should be?
So let's break down the Rule of 40 for those not familiar. My take on it is the combination of your growth rate with your EBITDA margins, and that should be over 40. It puts you as a Rule of 40 company.
Bingo. Yeah. Over 40 is excellent. The higher, the better. And the more weighted towards growth, typically the more favorably we view that.
Does that still apply with services companies?
It still matters. So growth and margin and the interplay of the two are at the core of how you value a business and how you think about future compounding of capital. In services, typically it's not 40 that we're targeting. We don't have an exact metric that we target in the services side, but we very much think, if you're growing faster, if you have more margin, over the long run, you're going to compound capital at a higher rate.
That makes sense. And then I guess we'll talk more about it in like the whole grand scheme of things of where the end goal and allows you to sort of value things today. Okay, so we have a business we identify that's looks like a good business as a standalone. The Rule of 40 ideally, if it's a software business. Does that include like your adjusted EBITDA?
We see a lot of adjusted EBITDA out there, especially, bankers are very creative in how they present EBITDA. So as we talk to businesses, we very much get to our own EBITDA number, which a different buyer might look at it differently. A seller might think about it differently, but we try to get to, what do we really think is EBITDA is a proxy for the cash flow of the business. What do we think that appropriate cash flow is going to be?
Okay, so you have to use your own approach and own guidance on figuring that out. And then is there, I guess, other things that you would really prioritize when you start looking at these businesses? Because I know management team's a huge one. Looking at the whole marketplace as a whole to get a sense of like, what can we, how far can we grow? Like, how do you think through those things?
Definitely. I mean, as we think about what's most important for us, it's team, market, and then business in that order. For us, team can be, the business might have some exceptional talent, and that's wonderful. We also have capabilities, and we do a ton of founder deals where we had, of a small software business, we had a founder who said, what's most important for me is that I am moving to New Zealand a month after this deal closes, and don't call me. I'm going off the grid. I'm living my next chapter of my life, and that's what I want. And so we have the capability to kind of solve for what a founder is looking for. In a lot of cases, that's a transition, that's retirement, that's shifting to a different role. So for the team, we have a ton of talent programs to be able to bring in a full management team day one if that is needed. On market, when you're starting with a $3 million EBITDA business or a $3 million revenue business in software, we have to have high conviction that we can do add-ons and scale this pretty quickly. And so underwriting the market, the fragmentation, the dynamics, why putting businesses together is better for customers, for employees, for the company. That's a huge part of our underwriting thesis. And then lastly is the business. So you need to make sure it has good bones, that you're starting with a good company, but really nailing all three of those is the core for us of making a good decision on the underwriting.
And then, so I get the team market with the business part?
Business. So the specific company. So it might be an incredible market. Are we picking the right business within that market to start with?
I got it. So the specific companies at the
Target.
right one to start with. Okay, so this makes sense. The team part's interesting. So if a founder has a lot of potential and could potentially lead the effort, that's a big plus. But you could handle a situation where the founder said, hey, I'm out. That's what I'm looking for as an exit. Would you value that deal differently then?
For us, probably 80% of our deals are situations where, the impetus for the founder selling is often that they want to retire or they want to move on to a different chapter of their life, or they were CEO and they love product and they don't want to be CEO anymore because there's all these functions that they don't love that are taking up their time. So we, tend to spend time on situations where our talent model is a differentiator. So other buyers, really want to back the existing team and the existing CEO. We love situations where our talent model can help differentiate us and help us be a partner to a business where other firms are less of a fit.
Okay, so you're used to it. It's not like a must-have.
We don't look at it as a negative. I think for some people, there's a mentality, if the CEO doesn't want to stay on, what does that say about their belief in the business? I think we realize for a lot of founders, it's all of their net worth that's been tied up in this business for 20, 30 years. We get that there's life outside of it and that there's human dynamics as to why somebody, might not want to be around for the next 5 years. And so we have a model that's pretty sympathetic and can help solve for that.
How do you look at bootstrap businesses versus ones with the messy cap table? Does that impact value?
We have done both. I'd say we're probably 90% kind of founder-owned and operated businesses. They tend to, again, our talent model tends to be a really good fit for those situations. And those businesses from a bootstrap perspective tend to have a little bit of margin, which is helpful from a valuation perspective.
Okay, that's fair. So got to have this team in place, and there's flexibility there if that there's transition required. Market, you want to make sure there's significant fragmentation so you're confident that you can find acquisition opportunities, and then making sure this is the right business to start with.
Exactly.
Sounds pretty straightforward. Can we like just walk through an example? Do you have something that you've worked on before that sort of played out pretty well that we can kind of walk through the steps of?
Yeah, for sure. And we have software and services. You brought up at the beginning, kind of it's interesting that we do both because they're so different. They are different markets, and yet the motions that we go through end up feeling a lot the same. So a software example, we built a legal tech business, so time billing software for lawyers, kind of SMB mid-market lawyers. We started our first business in that space was $4 million of revenue, so starting quite small, but a great market. We saw a ton of fragmentation. We saw huge tailwinds as people were splitting off of big law, kind of starting their own firms, and as people were going from on-prem solutions to cloud-based solutions. And it's a really sticky product. Once you have a lawyer on your time billing software, there's the ability to attach, a lot of other offerings around that. So, we felt from a market perspective, this is awesome. We also kind of prior to the market had built a team. So we had a CEO, a COO, a CFO. We kind of had a team in place on our bench ready to go who were just exceptional operators and leaders. So we had the team there. We identified the market, got really excited, started with a $4 million revenue business, which is on the small side, but ultimately did 4 additional acquisitions around it, kind of expanding into adjacent pockets that we were excited about, and then adding additional products that we could cross-sell into that base. Integrated all those businesses together pretty heavily, and ultimately built that to be a $30 million plus platform, and sold that as a platform for another PE sponsor that has gone quite well. And so a great example of kind of when you get the team right, when you get the market right, when you can piece together solutions that make a lot of sense, we can build really valuable platforms. And that's our focus. That's kind of the software narrative side. On the services side, it's much the same, but we might start with, a $3 or $4 million HVAC, so air conditioning, heating, cooling, plumbing business, start there, build a whole executive team around that business that's capable of doing pretty high velocity M&A, and then have built a number of businesses like that on the services side to be $100 million plus EBITDA businesses in pretty short time periods. So really have built out heavy integration functions, heavy M&A functions, but operationally really integrating them to be tightly knit, and have a lot of strategy for why an add-on is worth more to our platform than it would be to another buyer.
Use the word integration a lot. Mm-hmm. Can we talk through the importance of integration with these add-ons? And I think the thing I'm curious about is we work with a lot of roll-ups. Mm-hmm. And I think now the market's really wising up, or at least buyers are wising up, that there could be a company that's rolled up that's not integrated, mm-hmm. or has a backlog of integration work, and then value ends up getting written down because mm-hmm. of that. So I'd love to just kind of get your perspective of just how do you think through of integration and what's good and bad? And
Definitely. Yeah. I mean, and I'm a deal person, so I love deals, but the deals are the easy part in roll-ups. It's not hard to, find a business, close a business. Like you can do a lot of M&A. The very hard part is integration and operations. So how do you make this a really well-run platform? And the key for us on integration is people and systems. So from a people perspective, you have to be very clear functionally on what's living globally, what's living locally. Have we been clear and transparent? Is everybody rowing in the same direction and understands the vision of where we're going? And kind of people-wise, that's hard. Systems-wise, you need really tight systems. So some of our most acquisitive platforms will do 30, 40, 50 deals in a year. If you go on, an M&A tear and you lose visibility into your key operating metrics, your leading indicators, your financial performance, you're like a pilot flying in the dark without instruments. So it's really important for us to build an integration capacity to where we're getting everybody on standard systems, the same ERP, the same financial systems. We've set in place, the key operational metrics for a platform, and we can really track and measure, hey, we acquired this business with a thesis that we could drive revenue in this way, that we could benefit from economies of scale and procurement savings in this way. Let's make sure that the leaders really understand that vision and that goal. And then let's make sure from a metrics perspective, we're tracking to that. And we know where we got things wrong so we can adjust in the future. And we know where we have bright spots that we can scale and replicate in other businesses. So the systems is a huge part. And typically we're building an integration team to roll out systems, 20 to 30 days of closing an acquisition.
Because you want that data synced up so you can align it around those metrics that you're targeting for the add-on.
Definitely. And so that our operators, if you're running a large platform as an operator, you need to have kind of your dashboard up to know where are we performing, where do we need to address things, who are my top performers, who are driving, at the local level, awesome results, and how do we keep growing their careers.
And they need to roll back an update to you.
Yeah, exactly.
That sounds like a big component of your value creation approach is really emphasizing the integration. One of the things I've published earlier in the year is a framework called buyer-led M&A. Mm-hmm. And one of the pillars is synchronizing diligence and integration so that you can ultimately execute integration better. And I'm just curious of how do you do that? How do you think through or plan your integration to set it up for success?
It's a great question, and it's so important. And it's easy to be the deal person. We want to get deals done, and it's easy to put something in Excel, and it looks so reasonable. You're like, on this time frame, we can obviously drive this much revenue growth, and we can do this with margin. For us, it's really important to have operators involved in diligence. So having the person who's going to sign up and go deliver this plan be part of that diligence process with us, and understand the assumptions, understand the business, make sure they feel comfortable with the game plan. And then secondly, being very operational in our diligence. So understanding, what levers of a playbook we think we have, understanding how we diligence those, and then making sure the post-close capabilities exist at the business.
So you're tying it all in while you're doing diligence. You're really mapping your integration and making sure there's continuity there. How do you not break things? This is I'm not trying to be too sideways here. I interview a lot of integration folks, and it's always, the culture was mismatched and things like that, and things just kind of get broken during the integration process. Is there some approach to make sure that doesn't happen?
It's a total risk of integrations. And I think kind of to give a little history, in our early days, we were very scared of, breaking things. And so our mantra was, don't fix what isn't broken. I think that works to a point, but it often makes it hard to scale M&A in a way that's really productive. And so, in the early days, for example, we partnered with some businesses that had spent a lot of time on their charter of accounts and their financial system. They were so proud of it. They had gotten on a great system. They loved it. It was set up in a very customized way to their business. And we were trying to get to standard systems. And we spent so long, trying to marry up their system to this other business's system, and both loved what they were doing. And I think, one of those implementations took something like 12 months to try to reconcile all of this. I think there was a realization that we had, which is there's power in just transparency and clarity. And if our vision is to build a really big business that's, a leader in the market, we have to be able to do deals pretty fast. And that means we're going to have to standardize systems, and we're going to have to tell people up front, your system is awesome. We love that you built this. It's working for you. That's wonderful. And doing a deal with us is going to look like this. We're going to have standard systems. Here's the why. Here's how it ties into our vision. And for some people, that's interesting and they get it. And then for some people, it's not. And that's their prerogative. And we might not be the best partner. But really being clear and transparent as to the why, and also designing with the end in mind. So to be, $100 million EBITDA business in one of these services buy and builds, you have to make some decisions on the front end that are going to change things at the companies we partner with. And so we try to be really clear in the upfront deal. Here's what's going to change and why. And here's the things that aren't going to change and what we think is special about you. And we're not going to touch these aspects and mess up these things.
These are some powerful things you're saying right here of just, designing with the end in mind, having this clear vision, really being able to explain the why throughout. Can you walk me through, like, how do you run that deal process with it? Because I'm trying to get a sense, and part of it's like I'm learning, right? That, like, how do you like bring this up early, or when's the right framing of it so that it just sticks throughout that process? Because I feel like it's so easy to just jump in a deal, want to start modeling things out, come up with a price and saying, all right, this is how much we're going to, and just get to LOI negotiation, versus this stuff is like the soft stuff that I think is the most meaningful in terms of like people alignment. So like, teach me this. Teach me how to introduce this stuff and get it sticky, so the new people that join the deal don't forget and they're like,
right,
what are we doing?
Right. And I mean, I think it goes back to also why we start with team, then market, then the deal, because you have to have a team who's thinking about these things, the operations team who's going to inherit this, who's making some of these decisions, because they're going to have to live with this, for the next 5 to 10 years. And then the market, you have to understand what matters in this market. What are the parts of the business that we don't want to touch because they're working and there's high risk? What are the parts of the business that we can make better for the end consumer, that we can make better for the employee, that we are going to change? So for us, it's actually a lot of that happens before we ever find the first deal in a market. So we're trying to get clear on what's our approach to global versus local, what's our vision, what's our pitch for a founder for why we think we're the right steward for their business long term. So we do all of that up front, and we get really clear on that, because if we're not clear, we can't articulate that to somebody else. And then to your point, often before we're getting into valuation and data request and diligence, there's a face-to-face with the founder or the sellers of the business, and we're articulating what our platform is and what it's not. I think a lot of people in these markets take different approaches, and that's great. And so we're trying to find partners and businesses who are aligned with our philosophy, who are excited by it, who maybe don't want to switch out their general ledger system, but understand, hey, if I want to be part of this bigger vision, like, I get why I'm going to have to do that and why I'm going to have to sign up for some of this. So a lot of that happens, that vision conversation, that expectation setting conversation happens, well ahead of an LOI or getting deeper into diligence. And some people opt out, and that's totally fine, but we'd rather do that up front versus getting a deal closed and then having to go operate together and realizing there's misalignment.
That's so interesting. Doing this up front and really emphasizing it kind of helps you throughout the process, but when it comes down to the real grinding with integration, you go back to that same vision, your thesis and what the end state you had in mind. And I think that's where you get proactive on integration. Because again, the fail point I see is where companies are afraid to break things.
Definitely.
So they essentially do like a very minimal integration, and then there's backlog of actual real integration work to do. You don't do that.
We try not to. And, I tell you all this now, and this is also learned over a lot of years of stubbing our toe and making mistakes along the way. And like I said, in the early days, being reticent to make some of those changes up front, and being reticent to tell a founder, hey, we're going to tell you 5 inconvenient truths. Like, you're not going to want to hear these 5 things, but this is what we're going to do, and this is how we're going to do it. And I think we found when you explain the why and the bigger vision, people understand it, and it's easier to have an uncomfortable 30-minute conversation about those things up front and then have a ton of alignment for the next 10 years than it is to get into things and realize we have to make changes a year in that, just slow us down and are hard to kind of wrap your head around.
Let's blow up the bad. Yeah. We don't want to glorify this. This isn't easy. What's the hardest things to making all this work, the platform and making the add-ons?
Two things. One, we spend so much time up front aligning on a vision of what we're trying to build. If we're trying to build $100 million plus EBITDA business, we need the team to get us there. And we are often starting with a $3 million, $3 million EBITDA business to begin with. On the software side, kind of flip those to be revenue numbers. But we overhire the team in the early days. So we will hire that team to be the $100 million plus EBITDA business before we even have our sights on a deal. And that's expensive. So we'll hire, 5 execs to sit on our bench and work with us for 12 months to find the right market and find the right business. And then you have a $2-3 million EBITDA business, and you have a very, very heavy exec team. You're building out an M&A team, an integration team. So, it's kind of pulling a lot of that build up front for us, which has worked because it lets you go really fast, but it's hard. And it means you have to be confident you can scale the business because you've just taken on a lot of cost. And then the second thing is the integrations. To really scale and push M&A, you have to build the integration capacity up front, and you have to be able to integrate businesses and onboard them quickly. I think that's something that in our early days, it just took far too long for us to integrate and to onboard. And it really slowed down our pace, and it slowed down our visibility.
What do you do? Like, how do you prep a platform to be able to integrate add-ons?
First, you have to be really clear on what you're going to, you have to understand the market and have a vision of what actually are we going to integrate? Because you don't want to integrate just for integration's sake. You want to have a why. You want to be able to motivate and rally people behind a vision. So getting really clear on that and kind of doing the homework in advance. And then it's building, the team to do that. And so oftentimes we're ultimately building an M&A team and a separate integration team. And those are people that are systems integrators. They understand the nuts and bolts operationally of what's going to happen at the business, and they're able to go win with the partner businesses we're partnering with and actually go execute, roll up their sleeves and make that happen.
So it's kind of getting that leadership, just even in the mindset that this is what we're going to do. We're going to be integrating these companies. Maybe think about your domain and when it's going to take to do that. So 2 big things. It sounds like a big upfront investment that you got to invest ahead to have the team that can go execute on the big picture. And so when you're putting in these executives and they're in a tiny business to start with, it may seem a little off, but that's something you got to rationalize. So that's I can see it being a challenge. And then building that integration muscle early is the second big one.
Definitely.
So we get the platform and then we add on businesses. How do you know like the right pace of doing add-ons? And then like, is there a point when maybe you got to slow down for some reason? Is that the integration's the bottleneck or finances?
Yeah, it's a topic of probably the majority of our board meetings is, are we going too fast? Are we going fast enough? How does this map to our vision? So it's definitely a topic we are constantly talking about. In services, there's often a world where for the first 6 to 12 months, we actually go a little slower. So there's a world where you partner with 3 or 4 or 5 businesses in a space. We make sure our team is a really strong foundation. We make sure the systems we really have dialed, integrations we have really dialed. And we're also learning, this is our first time entering a market. Let's make sure we really understand the nuts and bolts of these businesses before we go crank pace. So often kind of a 6 to 12 month period of really dialing and building the right foundation because you don't want to build a house on quicksand and you want to make sure it's solid. In the software landscape, it's a little bit different. Typically we're doing lower volume M&A, so we might not be doing 30, 40, 50 deals a year in a space, but being really thoughtful about, for our customer base, what are the 2 or 3 or 4 products that make sense together? And in the software universe, when you're targeting very specific product categories, you have to be a buyer when there's a seller of those businesses. And there might not be, 10 payment softwares for lawyers. There might only be 2 or 3 that we really want to own. And you got to be opportunistic at the right time of when a deal can happen.
That's an interesting point that, you kind of may start off a little slower just to really figure things out and then figure out the right cadence. But sounds like it's a lot of variables to determine this. That it's not just, sort of one playbook that you apply to each company.
It's not one playbook overall. I think, what we've tried to do is make the process a lot the same. So we do a lot of visioning upfront before the first deal on just let's get clear on what our intent is. What what our vision is for what this platform is going to become. And then a lot of the decisions you make in the first 6 months, 12 months, 24 months come out of that. Once you're clear on that vision, let's work backwards for what do we need to do in each year of our investment to end up there.
Is there things that like may shift or change in that 6 to 12 months? And I kind of want to pick on that legal example because it's an adjacency for us even. You know, if you got one business and you said they were doing more of like time tracking, and then, you know, is it like in the 6 to 12 months, does the strategy shift? You start looking at market map different? Like how'd that play out in that example?
Yeah, so in that example, before we did the first deal, we had mapped the market. So in services, you know, sometimes there's 15,000 of businesses in your market, and so it's a big universe. In software and, you know, legal time billing, there's maybe 100 players there. So we had mapped them. We, before the first deal, had talked to probably 50, 60% of them already. So knew their size, knew where they played, knew the focus. And we kind of had our list and our vision of here's what we want to build to become. Here's the names that we think are a really strong fit with that vision. We don't know exactly which of those names is going to transact in a time period that works for us. But we know every quarter we're going to call them and talk to them and build the relationship over the long term. So we're who they think of when the time comes. We started with one of those businesses and then, you know, really focused on that pipeline and building those relationships and ultimately pieced, you know, 4 other of the products together and build those under a single leadership team. So in software, it's a little bit less. At times we control the pacing a little bit less, and it's more about being very thoughtful on these are the companies that we think are a really strong fit, and let's be on them every quarter to know where they're at and to be selling our vision and make sure that when the time comes, we're the first person they think of.
It is so different because I feel like services, I always think of roll-ups. HVAC, I think you guys have a roofing one, which is just very similar businesses in different markets, and you'll hone in on geography. Where software, there's just no two software companies that are like they're very different. And then in this example, I mean, was it, hey, do we kind of know this one specific vertical of time tracking? We're going to really go deep into that. You know, how do you start thinking of like adjacencies and sort of that view? And when is it time to go out of the core?
Yeah. So, I mean, in software, a lot of times we think about there's kind of adjacent end markets. You know, if you think of a grid, there's kind of one axis is the end market and one is the product category. And so you think about which product categories do we want to be in for which end markets. In the legal tech platform that I was talking about, we expanded both to adjacent end markets. So we had, you know, kind of mid-size corporate law firms. We expanded into personal injury law firms and, you know, SMB law firms. So we kind of expanded to different customer profiles. And then we also expanded to different products. So we had a time billing software. We added on a practice management business. We added on a payments facilitator. So kind of payments product to allow electronic payments for the time billing side. So we look at both vectors and think about, you know, where on this map do we want to play and why? What's our vision of what we're trying to become? Are we trying to cover the entire map or just, you know, these 4 boxes on that map? And then what companies are in each of those boxes? And let's be really intentional, to use your term buyer-led. Let's be very buyer-led about trying to make deals happen with the players who we think are tier 1 players in each of those boxes.
Meaning you're proactive, you reach out to them, you're not waiting for a book to get sent to you.
not waiting. And, you know, some people will still hire the bank and that's fine. And, you know, for a lot of people, it takes 7 or 8 meetings and a number of years before the timing is right. And so for us, it's just being top of mind when that time comes.
Wait, so when you say in market, you know, use the example, here's like maybe a small firm and one that specializes in different area of law. And then you have the products. If I think of like ICP or who the actual buyer is, where does that fit in? Is that part of your in-market view? And then you say, okay, like in this situation, it's whoever's doing the back office stuff or whatever. I don't know.
Right,
but you have
right, exactly.
this or an ICP. And that's where I was curious is like, how do you, is that the big thing? It's like we identify this product's going to sell into the same, because you could have a different in market, but it's a different ICP. which then all of a sudden you got smoky mirrors that you're not going to cross-sell as well as you thought you would.
Right. And it totally depends on if cross-sell, is the thesis with an add-on or not. I'd say for a lot of our software businesses, it is, we love this ICP. We're really good at the go-to-market on this ICP. Let's look at the 3 or 4 other products we know that same human is going to buy, and let's go be able to offer that to them. And kind of for the same customer acquisition cost, we can now 3 or 4x our lifetime value because we have more product to sell them. So that's a thesis for a lot. In some cases, it's not though. It's we're really good at this go-to-market motion in this size range in this market. There's other ICPs and other buyers of products who we have the right motion to go sell to, but we're not today. And let's expand via M&A into kind of an adjacent end market.
So you can get in this adjacent market, but it's more about a go-to-market playbook that you have that you can bring in and saying that's interesting. That's what I was curious about. It's like, how do you keep these acquisitions to be strategic instead of running that conundrum of we're just buying revenue? And that sounds like there's a view on that. And it's, maybe it's not purely cross-selling into the same ICP, but there's other factor that gives you an upside that you're going to be able to leverage, like the go-to-market playbook example.
Definitely. And it's just being clear for us. It's about being clear in the underwriting on what are the levers we're trying to pull. And then because we work so much with operators, typically have the operators on our bench before they go into the business, it's making sure they're really, sold on that. So when we're talking about cross-sell, let's diligence it together. Hey, you're going to be running sales of this business in, 4 months. Let's make sure you feel really confident on your ability to cross-sell these products or to explain this M&A this go-to-market playbook to, adjacent businesses.
I talked to a range of private equity firms, and I'm starting to see some patterns based on the fund size. And if smaller fund, especially sub-billion, all the M&A is handled in-house. But as a firm grows, then it could be that the maturity of that business where they'll stand up an in-house M&A function. What's your view on that? Like, when's the right time that you would want to stand up an M&A function and kind of let them run things and be more of like a coach than a driver?
It's great. It's great when it goes well because it gives the private equity firm a lot of leverage. For us, it goes back to what's the vision. So if we know we're going to do double-digit number of acquisitions, add-on acquisitions during our hold on a platform, typically we're going to build the M&A team at that platform.
Pretty early.
For us, we typically do it day one. So we're launching a platform right now. We're going to close the first deal probably in the next month or so. We have the head of M&A, the president of M&A. He's also starting to hire, 2 associates under him. So we're building that team even before the deal closes because we know it's so core to the strategy of that business and we want to be able to go fast. So in those cases, we're building that team. For us, we have a ton of talent programs. So we hire just awesome individuals and then later figure out where they're going to go. And so
you keep them on payroll until you figure out what to...
We keep them here on payroll. So we have a program focused on kind of that head of M&A, head capital allocator at our portfolio role, where we partner with people we think are exceptional. We then go find them a market and a business, pair them with a CEO, and drop them into one of our platforms. So that's where a lot of...
What kind of background are you looking for in that person?
Typically, direct investing background. So a number of them kind of come up through banking, have been on the buy side for a period of time, maybe went to business school, maybe were at a PE firm, but want to be a little bit more hands-on operational and entrepreneurial. And this is kind of a way to use their deal background, but go be an operator and the exec of one of our platforms.
This is pretty cool. May have to come back and apply for that role.
For sure.
Let's see here. I want to talk about capital structure. I want you to spill some beans here because I want to understand you are in fund. People put money in your fund and they're in high hopes of getting much more out of that because it's a long-term investment.
Right.
Is there like a target hold period that you have?
We underwrite our models to 5 years to stay disciplined and be able to compare things apples to apples. I'll say our bias is to go longer. So our fund life is 12 years. We can have 2 1-year extensions on that. Our bias is when you get the team right, the market right, you've partnered with great businesses. That's really hard to do and takes a lot of effort. And the out year compounding is often, some of the most accretive. So we will hold businesses much longer when we get those things right.
That's so true. I look at these tech companies, especially when you got the whole life cycle, like a 20-year span, and you're like, the first 10 years was nothing.
Right.
It was the last 10 years that just boom, all the value created, and substantially so. So that makes a lot of sense. What do you think of like metrics? A lot of times I hear, the 3X is sort of where you're trying to drive on that 5-year model. Is that like the standard in private equity?
Hard to say what's the standard. I think each firm has a slightly different focus. For us, what we talk about with our investors is targeting 3X net on our investments. And that's what we underwrite to within the 5-year period.
Okay. Let's play this out. This is where I get free advice out of you. Let's say tech company, us, is 50 employees, 10 million ARR. And I have identified 2 targets, each doing 5 million revenue. One is very competitive in nature. The other one is adjacency, which I'm like, hey, this actually cross-sells into our ICP really well, FP&A type of software. And so I come to you and I'm saying, I want to put this together at 20 million ARR combined pro forma and get you to fund that deal. Let's do like simple math. Can we just say 10X? I know we're going to negotiate on that based on other factors, and we can talk about how that plays out. So that would be like, what, 20X? And I'm asking you for 50 million, 40 million to put in the business so I can get these deals done, have some cash to integrate them, and then 10 million of secondaries because I got to go pay some bills. So we're modeling this out, but what I want to know is kind of your view, because you're looking at this investment scenario and saying, okay, in 5 years, based on what Kisan's asking for here, which is 200, I guess it'd be pre-money, then 240 comes out to be post-money, and then you need like 700 and some change, to exit out of it. How do you look at that? Because my big question mark is, this will put us at 20, and then 5 years, ideally to get that target, I got to get closer to like 75 million, right?
Yep.
So I probably going to need more money if I'm going to buy more companies. And we didn't talk about adding any debt structure to this, so we're keeping it simple. So yes, there's potential to add debt and do maybe one more deal. But that's where I'm a little stuck. It's like, this could sound great, and I get super excited to do it. But now, hey, am I on the hook and really got to push hard organically? How do you sort of think through? How do you help somebody like me think through? Really closing that gap to deliver the results that you want, so we're aligned.
Definitely. First off, the majority of what we do is kind of majority positions. And so, typically not coming in an exact situation like this, but play out the example.
We'll play along for fun.
Yeah, to play along. We do use kind of conservative levels of debt on the business. If you have strong organic growth, you could see a world where in 2, 3, 4 years, you are able to leverage cash flows from the business depending on the profitability. You are able to leverage kind of the incremental debt capacity you built to do M&A without needing a significant new chunk of equity coming in. So that can be very accretive M&A. The key is to be conservative and appropriate in the leverage level, so you're not hamstringing the business from executing on the organic growth and the product initiatives that are compounding the business. And so, in most of our deals, we're thinking about a mix of organic. How do we supercharge organic? What investments would we make in product or in team to go faster? And we're thinking about the inorganic and how can this business over time, through cash flow, through capacity from leverage, go do really accretive M&A.
That's why I get jealous of the service businesses, because it's easier for them to do that.
Yes.
Tech, it's like everybody's losing money, and everybody's got high evaluation expectations on top of it.
Exactly.
So there's that part. So there's a component of debt. Maybe, I don't know, as much as cash flow getting invested in to do it. I guess, is there that area of thinking through of like, if you're going to need more money to go do acquisitions? And I guess a little different, maybe in your view. I mean, is that something you just sort of factor in? And, is it looked upon all at once that, hey, this is how much capital need we have to do acquisitions for X years, and then after that period, we'd look at another tranche of equity to put in the business?
So I can't speak for other firms. I mean, we are reserving, when we do the initial deal, we're reserving capital knowing that there's probably going to be needs for additional equity funded M&A in the future. So for us, typically, in the services side of the business, maybe 10% of your initial equity check is going in on the first deal, and the rest is coming in through time with other acquisitions. And then on the software side, probably less than half of your ultimate equity check is going in on the first deal, and more is coming on as you do that M&A. So again, it goes back to having that alignment up front. Where it can be a problem is if the strategy was we're not going to do M&A, and then 5 years in, an amazing deal comes along and the private equity firm hasn't reserved for the ability to do that deal. So for us, it's getting really clear up front and sizing that appropriately, and then on our end, reserving that capital for future years.
That makes sense. So it's just all planned ahead of time, but then things could change.
Things do change. So
they have a board meeting to talk about it.
Yeah. And something we try to do is kind of reset that plan once a year. So one of our board meetings each year is rethinking, the 5 to 7 year vision and rethinking the ultimate exit plan. And sometimes it's not always, doesn't mean that we want to exit the business or anytime soon, but rethinking what that vision is and how things have changed. And, we often see businesses get there faster. So maybe we set a 5-year vision and we hit it in year 3 or 4, and that's great. And so let's reset a bigger vision and think about what we need to change now to go even bigger.
You mentioned this in-house program, which is really intriguing because you'll have CEOs in-house ready to go. Are they out looking for deals too?
They are looking for deals with us. So, what we mean by our in-residence programs is we hire, a CEO, a CFO, a CPO, being people, not product, CPO, an M&A leader. They are sitting in this office. So a number of them are kind of right around the corner over there, come into the office every day. And we staff what we call a pod around them. So a part of our investing team, a part of our sourcing team, and that team is only working on that and trying to find a market and a business and start a platform, over the next 12 months. And
so they're all working together as a team.
They're working together side by side. And we have sourcing professionals and investing professionals kind of helping them, coming with ideas on market. So it's really collaborative. We want to find something that they're going to be excited about because they're about to vote with their feet for the next, 7+ years, and something that's a fit for their background. So we try to have people who are athletes who can go into multiple industries. But if they come from B2B software, let's go look for something that's B2B software. If they come from field services, route-based field services, let's go look at route-based field services options. So very collaborative, but they're working hand in hand with us and very much a part of those teams and bring a ton of credibility. So when we go meet with businesses, they want to talk to operators typically, not investors, and that's a huge selling point.
Is there any programs for developing the talent while they're in resident?
Yeah, so we hire experienced folks, and then ahead of that, we hire a lot out of MBA programs. So these are people with, 5 years experience. We have a path for those folks to be CEOs in training and one day become CEOs, a path for them to be capital allocators and M&A folks, a path for CFOs. And typically they go into our portfolio, study under a seasoned executive, so spend 3-5 years at a company learning from somebody who we think is exceptional at that. And then coming back and doing it again with us as the ultimate CEO or CFO.
That's interesting. So you kind of almost like an apprentice model, kind of partner them up and get them firsthand exposure.
Exactly. And we have 100+ of those folks at different roles across our portfolio right now.
That's so interesting. What is the incentive for these? And you kind of got different ones, right? You got folks that are experienced and folks that are pretty new, not quite proven. But when you do get them set up to tackle an investment thesis and go out and drive it. What does that look like? If you can share, I don't know if it's like standardized in the industry and whatnot.
You mean in terms of incentives? Or?
Yeah, because I mean, obviously there's cash comp, right? Let's forget about that. That's like market. People can go look at any kind of salary reports out there. But for like the equity stuff, like what gets them super fired up about working with PE? Because it seems like all the rage these days.
Yeah, I mean, so we structure kind of profits interest pools. So it's basically a percentage of the profit generated on that investment. We set that up as a pool, so they have the same incentive that we have, which is the more profit we generate, the more they make. And I think for a lot of them, once they see the power of M&A done right, the power of integrating really well and being able to grow through acquisitions, they really lean into that model because it can generate really powerful returns.
Does it profit like on the exit?
Yes.
So they got to be in for the whole ride.
Got to be in for the ride.
This is beyond golden handcuffs. These are like
exactly
titanium.
And they're, I think for us, like I said, the team is the number one most important. If there's one thing we have to get right between team, market, and business, we pick team every time. And so they're a huge part of building the platform, of the success of the platform. So it's important for us that they're kind of have the same incentive that we have and are in it for the life cycle of this investment.
So you got the management team, you incentivize them with profits on the exit. The team that nobody talks about, the board. Is there like a approach to really have you seen to get the right board that's going to be accretive to these investments?
Yeah. As much as possible, we'd love to have CEOs who have been there and done that in a related business, be board members, board advisors. So we cross-pollinate a lot of our platforms. Like you mentioned, we have an HVAC business, we have a roofing business. Both are residential home services businesses. So the team from the HVAC business is on the board of our roofing business, and it's phenomenal because they learned a lot in building their platform, and they can say, man, there's 5 things that I would have done differently in my first year. Let me just tell you those 5 things so you don't have to relearn them. So we try to cross-pollinate that way from an operational perspective. And then also having, thoughtful deal people who can help think about M&A and think about the acquisition side as well.
So you might have some folks that are really experienced in M&A, but the operators, get them on the boards of the other companies. And then being a board member is the same thing, profit on the exit of the deal. Do they get salaries?
We don't do any of that stuff. So
you got to be on a public company to get get the private
and
jet
outside
access.
board members, there's different incentives for outside board members versus people from the private equity firm that are in the board.
What's the operating partner role in the PE firm?
It depends. We don't at Alpine have traditional operating partners, so that's not a big piece of our model. For us, it's more take CEOs that we work with and kind of cross-pollinate that way to provide the operational lens, and then have people from the Alpine level sitting on the boards of our businesses as well.
So really in-house type of approach. Mm-hmm. All right, Haley. So I got to ask, not every investment goes picture perfect. And I hear about things going sideways pretty often. I think that's always the fun thing we like to gossip about in our industry. Can you tell me about that? Like, I don't know if you're even comfortable sharing a story, like anonymously about something that went sideways, but like just curious, like how do you like respond to that? Is it just like what actions do you take? Is it a point where you just write off the investment and just, I don't know.
Yeah, I mean, it happens. I wish it didn't, but we try to do everything we can to avoid it. But, things go sideways. Things go differently than planned. And I think over the past 5 years, that's become more apparent. We owned a ton of K-12 businesses. In 0 of our underwrites did we expect K-12 schools across the nation to be shut down, for people not to be in person. So, there's always things. We have downside cases, but there's always things that are unexpected that come up and happen, and you have to adapt and respond. That's why I keep saying team is my number one thing, because when you have a phenomenal team, they get creative and get scrappy and come with ideas to board meetings about, here's 5 different paths we could go down. None is what we expected to be choosing between, but let's talk about it and let's figure out what we're going to commit to and where we're going to go. And maybe to give an example that's not COVID related, sometimes we also get the market wrong. As much as we try upfront to underwrite it, to build a pipeline before we close the first deal, to have confidence we can scale a business, there have been times we've gotten the shape of a market wrong, and the businesses of scale, and by scale, I mean, $1 million plus of EBITDA. So for a lot of people, that's not scale, but the businesses of scale maybe were fewer than we expected. And so this market has a ton, I'm thinking of one example, a ton of 200, 300, 400K EBITDA businesses. That's very different than what we expected in the underwrite. So a year in, we're sitting down with management. We're looking at the plan saying, where do we go from here? And the answer is we have to build capabilities we don't have today. We can't be doing, 2 million EBITDA add-ons, which are very different and are full businesses. We need to be able to acquire 200K of EBITDA at a time. And we have to build an integration engine and an M&A team that can do that. And that is very different than what we've built today. So we're going to pivot it. Here's the operational plan. Here's the target. Here's how we make this happen. And so for us, it just comes back to having awesome operators who are going to play through it with you, who are going to be committed to this business for the life cycle of it, and find a way to win one way or another.
Number one characteristic you look for in an executive team leader?
Will to win.
How do you do that? How do you test them for the will to win?
A lot of rounds of interviews, a lot of references. And I think for people interviewing and understanding their motives and their attributes beyond, their experience. Because on paper, there's a lot of very qualified people, but really trying to understand the attributes of a person, what motivates them, and how that's going to align or not align with what we need to do in the investment.
You say that, I'm like visualizing the Shark Tank with like an apple dangling above it. It's like, all right, you got to get the apple. Show me your will to win.
Yeah. And some personality assessments, we do a deep dive and it goes back to childhood and people's reflections on their childhood and what they learned. And, 4 hours later, you come out usually with a pretty good sense of who they are as a human being. And I think getting the human element right is as important as getting the person who on their resume has the experience. It's
a tough thing. That's a whole other interview that we'll have to reserve for another time. I need some advice before we wrap up here. I'm not quite doing a majority, so we might not talk this time. But for somebody that's thinking to do a minority recap, and I'm trying to basically sell our business as that platform. I was under the impression I'd try to go stack 20, which would be good, but it sounds like there's some open-minded firms out there. And I think I'm trying to do it based on a combined pro forma that sort of gives a nice position that where capital is getting allocated, and it kind of helps you out from valuation and so forth. But being balanced, I think, is a key thing I'm learning. That if you get too greedy on the front end, like the 21 valuations, you're going to pay for it later. So, and I know there's like a lot of companies just riding the AI wave and they're putting all that and getting a high valuation. It's like, no, I understand you want to be really reasonable so that you can be aligned and work together to achieve the end goal. Based on that current thinking, what advice do you have for me just to, as I approach leaders like you in the investment side of working together and just making sure I'm heading down the right direction?
For sure. On your part about kind of stacking to the 20 and having thoughts on M&A that you would want to do, my biggest advice to founders and businesses is get really clear on the playbook. I think anybody can do M&A or bring businesses together, but really being able to have a clear vision of what would I do with this business? How could my team or our teams together make this business more valuable, the whole more valuable together than the sum of the parts? And it sounds like for you, it's, cross-sell and getting really thoughtful on why do you think you're going to be successful at cross-sell? Is it the same ICP? Is your team capable of cross-selling? Do you have partnership relationships today that show you can kind of cross-sell and further monetize your base? And so I think for us, the businesses that can articulate a really clear playbook for why an add-on is worth more to you than others helps make it a really interesting and unique opportunity and shows up in the valuation as well.
You got a fair point that I should really validate this stuff. And I think even some of the partnerships we have, I feel like we can probably invest more to make them performing, and then be able to leverage that to even validate like, hey, this is why cross-sell would work. And we could probably validate if it makes sense to acquire those companies.
And finding a partner that, is aligned on that vision. I think in my career, there's been times I've probably been, so interested in the deal, and it's so easy to like oversell or force a partnership that isn't a good fit. And I think over time, I've just seen you want to be super clear about what you're looking for, what you want in a partner, what you don't want. And there's going to be businesses out there, or for your case, private equity firms who might not be a fit, or growth capital firms that aren't a fit. And I just think life is too short, and finding partners that are really aligned makes the next, 5-7 years so much better.
The working relationship.
Definitely.
Haley, what's the craziest thing you've seen in M&A?
Seen a lot of crazy things. In M&A specifically, we did an acquisition in Germany, and I learned that, I thought it was a joke, but in Germany, your purchase agreement needs to be read by your legal team before a notary public. And it's, a 15, 16-hour document to get through. And so it's just humbling, as you work with different countries and in different regions to realize that there's a huge local dynamic of what you do. People are all different. Countries are very different. And so that one was, it's just fascinating. This age of AI, reading the purchase agreement before the notary.
Did you sit through the whole reading?
I did not, but our team did.
Those of you want to learn more about that, I actually, I think Frank Temper, one of the attorneys, I believe it was Denton's, that was in Germany. I actually interviewed him in Dusseldorf, and we talked a lot about this. So, yeah, you're absolutely right. It is so wild how different countries have different rules around doing M&A.
Definitely.
Haley, this has been an awesome conversation. I really appreciate taking the time from doing deals to helping me become a better M&A scientist.
Well, this was super fun. Thank you for coming to our office, and we hope to have you back soon.
I am. I'm going to apply for in-house residence role here.
Send us your resume.
Anybody still listening here, fellow M&A scientists, I appreciate you. Thank you so much for listening through. Always welcome feedback. Reach out to me on LinkedIn. Connect with me there. Love to hear what you thought about this interview. If you got any topic ideas, be careful asking for favors. Get too many of those. But till next time, here's to the deal.